So the deep pullback, like we said, the normal pullback is state 2, and the deep pullback will be in state 4. So that's the big difference between them. So it made an extended pullback, so that's why we just call it the deep pullback. So we're just looking for it to hit that first target, and also in state 4, and also to cross below the lower Keltner channel. So like I said, when it goes from 2 to 4, when things go into 2, typically the bullish stocks, unless the market really rolls over, when they go into 2, they'll bounce back out of 2. When the market rolls over, then they're going to go to 4, and sometimes 8. Like during the coronavirus and the rate rise, they went into 8 at that point. But most of the time, you see these drops. The sky's falling, it drops 5% or something, and then all those trades work like magic. It's just when there's huge, big systematic risk, about they're going to shut down the economy or something like that. That's when you have to be very careful. And if you hold it through it, it will typically, level out. But obviously, you don't want that to sit through that, if possible. So what we use here, it's cross below. We're using the same thing, the Keltner 20 days to ATR. And then we're also looking at state 4 target 1 met. So this is the same explanation. I think, obviously if you have questions on this, I'm not going to repeat myself exactly since we already covered that. So on 6/24, we had a Biogen come in to a Keltner deep pullback. Now the deep pullback, we also use long call. So we use long call, and bull put. I pulled up, the bull call on this one. Obviously a higher price stock. So, it's a nice, in this readout, it gives you your max risk, and that's based off of, the previous day's close. So all of our data is end of day. So if you wanted to get into this trade the next morning, depending on how the stock moves, it could be higher, lower, similar. So typically we say if you're getting into a long call and the stock spikes up the next morning, you probably want to just hold off on that one. Since most of the move, if it's up 3 or 4%, pre-market, then I would just kind of pass on that trade. But obviously up to you, but that's what I would do. So when we look at the parameters on the entry, so it had crossed below a few times here, and then 6/24, it had just crossed right above and then went down below again, and at that point it had met the target. So it has to meet those two things in unison in order to trigger a trade. So it did that on the 24th. So we can see trade entry, drifted a little lower, and then we had a big spike up, and that's probably ball game there. If not, it definitely did it here. See chats coming in. Yeah, I'll put these slides in the share drive that we have, and I'll send that out. I'll send that once Sean's talking. I'll put it in the chat, or our Google Drive, and I'll populate them in there. So, so here's the long call results. So, fairly expensive. It's a fairly high price stock. We're paying almost $1,000 to get into this. But like I said, 7-8, a big spike, even though it closed a lot lower, it obviously hit that 25% and more. What we tell people, when we do this in our earnings, we have a bunch of different earnings trades too that people love. Feel free, on our YouTube channel to go. We recorded that webinar, so you can go in and look at that. But like when you get into these trades, if you want to do kind of hands off, you can always put in a limit order for, the profit target that you're looking for. So these are 25. So if this thing, opens up way high, and you have that limit order, it'll automatically trigger and you'll get out, and it'll be obviously well above what it closed at. It can work in, the reverse order too. Maybe it opened here and then it closed here and you got out at the open. So, we kind of like to do that where, it's automatically always looking for that profit for you. A win's a win. So that's just kind of how we look at it. Okay. So, the bull put took a little longer. So this one was closed in a couple weeks. This took a few more weeks after that. But, still made profit. Obviously, I always kind of look at the comparison between the risk. So this one, and that's kind of how I would at least approach these is, okay, risk to reward. As I said in the back testing, everything's a trade-off. So you kind of want to analyze risk to reward as far as, how much you can make, how much you're risking. And I think that's, the difference between, what you want to do with bull calls, long call. Some people just don't do long calls, but, the difference between the bull calls and the bull puts, you just kind of want to look at, okay, how much can I make? I can make 187. How much can I make here? You can make a lot, 15, so, but you're going to be risking a lot more. So you can actually do a ratio analysis between those two and see, okay, which one's the better one? If, obviously your amounts aren't, if you're not limited to a $3,000 trade. And the other thing, just kind of want to repeat is, if this strategy of, buying deep in the money and selling right above, you can go in and tweak that to, if there's a certain characteristics that you prefer in your trades, and you can test that really, really quickly to see if that's better for this symbol. So the long call worked real fast. A couple weeks more for the bull call here, and then the bull put worked real fast too. That was actually the fastest one. So I still think it's preference, between the bull call and bull put, but the long call, obviously some people are pretty risk adverse, and if you don't get direction right, your odds of, especially at a 30 delta. So the reason we picked that 30 delta is, the testing told us that, if you get direction right in a fairly short amount of time, this is going to be your best overall, your best delta to trade at, 30, 35. If you don't get it right, then, your decay starts hitting you pretty quick, and you'll see that. So overall, as far as, the long calls on the deep pullbacks, obviously pretty flat here, and then, that, excuse me. Obviously, the big dip, and then, a real strong comeback after, the coronavirus stuff hit. So kind of highlighted in, to give you a reference date there. But overall, winning, 78%. And, you know, like I said, you know, we did all these testing. So it had to be above 75%. So the funny thing is most of these do match up. I mean, there's one or two that, you know, isn't doing spectacular, but some do better than how they tested over that, you know, 2007 to 2017 range. And some lately, you know, they started strong and, you know, had some issues, but nothing extravagant, obviously, but most of them are pretty much matching up to how they modeled previously. So the bull call, you know, we're looking at 83%. You know, some of the other things here, you know, we're looking at profit loss per day. So this is for every day you're in the trade. In the trade, you're making $7.06. You know, here's our total trades, losses, and then, you know, our wins, and then rejected. That's just if we had issues assigning, you know, sometimes the standard deviation strikes won't be available depending on the symbol. So some of those will get rejected, but most of the time, as long as you're seeing a fairly small number, then it's not an issue. But you know, we have to go back individually and try and resolve those rejected trades by themselves. Let's check the. Okay. And then, you know, average risk 14. So, you know, you're risking 1,000 more, but, you know, obviously you're making, you know, so the difference between the two strategies, the long call, you know, your win percentage is less, your profit factor is less. You know, comparing profit, you know, your ROR, return on your money, is a little higher for the call than, you know, because you're risking so much here. But if you look at average days in trade too, so these are typically, you know, sometimes we'll see these things hit in a few days, and, you know, anywhere from 15, you know, the 20 is kind of the average. Sometimes they go longer, but a lot of these trades will hit within the first 2 weeks, and then, you know, the losers that you're holding for 90 days really drag up that days in trade average. So. Okay, so, you know, bull puts, similar, 90% win rate, looks spectacular. You know, it's just these, you know, when the market tanks and when it hits those standard deviations, you know, these things turn real quick. As long as it bounce back, you know, you're good. You know, the thing I would say about this is, you know, obviously we're not trying to hide anything. You know, if I wanted to show like perfect graphs, you know, I could do that. I want to show you the daily, so that, you know, you're aware, like if stuff's happening out in the market and you're getting jittery, you know, you don't want to just follow these blindly. These are trade ideas. So if you're not bullish, you know, don't do bullish trades. But, you know, overall these win, you know, consistently when the market's nice and good, no issues. And then when things creep up, you know, just be careful. Okay. See, Sean's doing a good job manning the chat, so let's keep chugging here. All right, so we have two more for me.